My name is Serge Berger, and I'm the founder of thesteadytrader.com. I think you made a great choice to attend this webinar today. What I do is I help traders and active investors reach a level of consistent profitability that they never thought possible. Did you know that the reason why most traders are not making money is because they overcomplicate things? That's right. Most traders make things too complicated, and I think it does go a little bit in the direction of what the previous presenter said. So today, what I'm going to show you guys is a highly profitable three-prong trading approach that has not only made me a ton of money over the years, but has also already allowed hundreds of traders just like you to live a life of financial freedom by reaching consistent profitability. How would you like to be able to get up in the morning and not care which direction the market is heading because you know you have a simple, trustworthy, and repeatable process that consistently keeps you on the right side of the market? Furthermore, how would you like to be able to do this from a beachside hotel room in Hawaii or your slope-side hotel room in the Alps? Well, that's actually a very realistic lifestyle to have if you learn to follow the straightforward three-prong trading approach that I'm going to show you guys today. Financial freedom is what many traders aspire to, and my three-prong trading approach has allowed me to live a wonderful lifestyle where I spend part of the year here in sunny Florida and the other part of the year in Switzerland. When it's not so hot in Florida anymore, then I usually gravitate over to Switzerland. So success as a trader is really not that difficult, and with the approach that I will show you guys today, I am sure everyone can do this. So let's get moving over here. Again, the title for today is the one candlestick pattern that is going to change your game. A little bit about myself for some perspective. I have been very fortunate in my career to work both on the sell side and the buy side. So I have worked at JP Morgan on the investment bank side, and I've worked at various hedge funds. So it's allowed me to see multiple asset classes such as equities and fixed income and derivatives of all sorts. But it's also allowed me to work with some of the very best traders out there, now I'm able to pass this knowledge on to my direct clients that I manage money for, and of course my subscribers and the broader audience such as yourself. So that's a little bit of background on me, so you kind of know, have a little bit of perspective when I start presenting here the meat of the presentation. As I said in introduction, I'm a big fan of keeping things simple. I really believe that trading and investing does not have to be complicated, and most traders and investors really do overcomplicate things. And they do so by basically looking at too many conflicting data points. And especially in this day and age with social media and email and anything else going on out there, we have a lot of information that's being thrown at us every single day. We need a way to eliminate that noise. And the more straightforward our process is, the easier it is to actually be able to stick with it. I'm going to say that again. The more straightforward your process is, the easier it is to actually stick with it. And that's a really, really important point. The very best professional traders have a simple but a repeatable process. Again, that's really important. The best professional traders have a simple but a repeatable process. And I think this has been mentioned in several of the presentations today already. The repeatable process is the really, really key point. Many traders and investment banks or hedge funds only focus on one or maybe a handful of stocks, but they get really, really good at those. And in fact, the two very best traders that I know, they only focus on one or maybe two types of trading setups, but they are amazingly good at those setups. So the question then begs, if the best traders only focus on one or maybe two strategies or so, or a couple of stocks, then why do many private traders think they need to become a jack of all trades when the pros don't even do that, right? The key to success is to become an absolute expert at one, maybe two type of setups or something like that, and then look for those setups across the universe of stocks, indices, or even other asset classes if you wish to do so. Alrighty. Sort of in line with what I just said, institutional traders have a very simple and repeatable process. I can tell you this after having traded for nearly 20 years and worked at the banks and the hedge funds. The very best traders that I've worked with had a very straightforward process. And what I'm going to show you guys today is an effective but repeatable three-pronged trading process. Everyone can do the straightforward approach, and I think by the time we're through this presentation in the next 40 minutes or so, it's literally will have changed the way you look at financial markets. Okay, that's potentially a big claim to make, but I know that many people, when I give this presentation, send me emails saying, listen, you've literally changed the way I look at things. So so that's that. Before we do that, real quick exercise, and you can answer this and type it into the question box if you like. Otherwise, it's, you can just answer it yourself. I think it's important that we understand where we are in the learning curve. It's always important to remain honest. So if you are a beginner, you're just reading and studying, you're probably in this level number 1. If you've done this for a couple of years, you're still not really sure what you're doing, you're going through the initial emotions of fear and greed, you may be in stage number 2. And if you've done this for more than a couple of years or so and you're still losing money, or you're not making as much money as you'd like, then you're probably in this third stage. And the thing is, if you are, I'm getting a lot of 1s, 2s, and 3s. I'm getting everything here. So some people, someone's even saying 3 with a question mark. So so that's a really good mix. But basically, if we are looking at stage number 3, you have done this for long enough that you're probably very, very close to making it work. And in fact, I know a lot of people, once you start looking at the markets that I do, it's just, it really helps them turn the corner. So real quick on the agenda, and then we'll get right into all the beautiful stuff here. So what I'm going to explain to you guys is why identifying investor mood or emotions is critical to success as a trader and investor. I'm going to show you guys how to consistently find the highest probability points to buy any given stock, index, commodity, or currency. And then I'm going to tie all this together and give you guys the blueprint to this amazing three-pronged trading and active investing approach. Okay, so I hope you guys are excited. Let us do this. Okay, so I don't know how many of you guys are familiar with candlesticks. What I'm not going to do today is give you like a real basic 101 thing on candlesticks, although I'm going to quickly review the real basics here in just 1 second, but the presentation is focused more on the strategy than what a candlestick is, but I'm going to quickly go through the basic anyway. The reality is that many people out there are trying to use the candlesticks, and a lot of people are trying to teach you this stuff. The reality is that there are only a few candlesticks that actually matter. There are way too many candlesticks out there to learn them all, because most of them actually tell you the same thing if you learn how to look at the market the way I do and the way that I've learned it over the last 20 years at banks and hedge funds, and that people really use it with. So you've got to focus on the ones that work, right? Shocking. So it's all about keeping it simple there as well. So basically for candlesticks, for those of you guys that have never seen a candlestick, we have basically essentially 2 types of days we can have. We can have either an up day, right, or on any given day in the market, or we can have a down day, right? Now, candlesticks is important to note. Of course, you can have this in any time frame. This could be a weekly bar. This could be a 5-minute bar. It could be whatever. I'm going to use daily time frames for today's presentation. Okay, so each one of these bars and candles we're going to go through will represent 1 day's worth of price action. So in the case of a down day, which is the candle on the left here, one with this filled or black body, you can see there was an open here, a lower close, and then a high, and an intraday high and low that extended beyond this open to close range. Right. Same thing over here. We had an up day, so we had an open, a higher close, but an intraday range that extended beyond the open to close range. Okay. Now, what's really important about all this is that you essentially have a relationship in every single candle between the daily high, low, open, and close. And depending on what that relationship looks like, you essentially have different types of sentiment that you can read it through. So for me, the most important thing is the daily close, the end of the day. All right. So let's continue. Basically, one of the main reasons why candlesticks work so well is because they're very visual. The reality is that more than 60% of us have a much easier time learning stuff by seeing a series of pictures. So I think of my 3-year-old daughter. It is much easier for her to understand stuff that if I give her a series of pictures and if I try to explain something using a lot of words, or God forbid give her a bunch of numbers, right, which she doesn't know yet. So being visual is what most of us are, and we have an easy time learning stuff. And the thing about candlesticks is that they are very, very visual, and they're much more visual than, say, bar or line charts. If you, for some reason, are using a line chart for you investing in trading activities, this is going to be a real eye-opener for you today. Okay, line charts are good for, you know, plotting an economic data point, but it's very, very bad for trading, so it doesn't really tell you anything. So we have the clear visual representation of what's happening in the chart. That's what Candlesticks do, and this is the most important thing, guys. If you take nothing else away from the presentation, write down the following thing. Candlesticks, yes, they display price action, but much more importantly, they show us investor sentiment and basically the footprints of investors, okay? Investor sentiment, emotions, and footprints, and that's the key to what I'm going to show you guys today, okay? Now, the thing about candlesticks is the reality is they just work, okay? The formations are very simple and straightforward to spot, and it's all about decision making without emotions. You have defined risk, clear stops, and price targets essentially before you get into the trade. Now, if you look at this person who chose this picture, because this person has very, very defined risk, right? So his or her risk goes essentially from nothing to like 100% when she goes above beyond this cliff here. So it's the same thing with candles. We know exactly where we need to get out when we have a trade open, and so it really helps us to basically make, again, like I said before, trade without having any emotions attached to that, and that's really, really valuable. So let's look at two types of candlesticks that I want to show you guys for today's presentation. Now, each one of these four types of hammers are the same thing. We're just going to go through more or less, okay? We're going to go through this number one here, the one in the top left. Let's assume there was a multi-week, multi-day downtrend, okay? Let's assume there was a multi-week, multi-day downtrend, and you get a hammer like this, a day like this. Now, there's two ways of thinking about it, okay? I'm going to give you the CNBC version, and I'm going to tell you the reality, okay? Now, again, multi-week, multi-day downtrend, market comes into this day, opens here, okay? And something happens and the market pushes lower, reverses sharply, and actually closes a little bit higher than the close on the day. If you think about this in CNBC terms, you'd say, well, we closed off the lows, Bob, back to you, right? Doesn't tell you anything. If you think about this through the lens of investor psychology, what actually happened is that after a multi-week downtrend, the market came to this day. The bears, growling loud as hell, came in and they pushed this market lower intraday. But something happened intraday, and they failed to hold the market lower, and the bulls took over. Okay, what happened is that many bulls, maybe the last ones, actually completely caved in and became bears. So the point of maximum bearishness occurred here, and there was no more sellers left, and the market reversed higher. Okay, that's how you think about this in the lens of investor psychology. Let's continue. Another candle we can look at is called an engulfing candle. Okay, let's take a bearish example. Let's assume we had a multi-week, multi-month uptrend. We came into this day, which is sort of a blah day. We had a bit of a consolidation day. The next day, the market rallied higher. Okay, you can see after a multi-week trend, the market once again did gap higher the next day. The bulls tried their very best to push this market higher, miserably failed at doing so, and the market completely reversed, fully engulfing that previous day's price action, all right, closing near the very lows of the day. Now, if you think about this, again, in CNBC terms, you'd say, well, we closed off the highs, Bob, back to you. Again, very useless statement. What happened in reality is that the bulls tried one more time to push this market higher. The last of the bears caved, so there was no more buyers left, and the only way the stock could go was lower. Okay, and I'm going to give you guys a lot of examples about this in just a second. Okay, now we're going to skip this part here in the interest of time because I know we only have 45 minutes in total. I'm going to show you guys the first example in the SP 500. We'll blow up this chart here, make it larger in just 1 second. Okay, so stay tuned. So essentially what we had here take place, this was October 2014. We had a waterfall sell-off followed by exhaustion selling, a strong bullish reversal, and bullish continuation buying. Okay, as I know it's a mouthful, let me walk you through it. So this is, again, it's October 2014. What happened is that the market had a sharp multi-week sell-off, if you might recall, and we came into the middle part of October. I think it might have been the 16th of October or so. And the bears, after a multi-week celebration, came in one more time and got very greedy and tried to push this market lower. You see that? What happened is that intraday, the bears completely exhausted themselves. So last of the bulls basically became bears, so there's no more sellers left. The market then rallied higher. Didn't close higher on the day, but it closed very, very, very much off the lows of the day. Again, because the bears exhausted themselves. The next day, we had a similar type of price action. The bears give it another shot. Didn't quite get as low as the previous day, and the day and the following day, on the third day, there was a very strong follow-through buying day. What happened in the follow-through buying day is that day scared the pants off the whatever bears there were left, or actually of the bears, I should say, because everyone was bearish, right? And that essentially got a massive squeeze higher going. Okay, so the highest probability point you're going to buy any stock, index, commodity, or whatever, is where you find the maximum bearishness. Okay, and that's how you note these by these long bullish reversal tails, among other things. Okay, next example, KBW Bank Index, BKX ticker symbol. Again, same exercise. I'm going to go through the chart here in just a second. I'll blow it up and make it larger. By the way, the BKX is a wonderful index to follow. If you guys don't have that on your watch list set, it's of course representing the banks, and those are very important to follow. So what happened here is this is actually last October, so just a few months ago, we had a bottoming process followed by exhaustion selling, a strong bullish reversal, and bullish continuation buying. Again, that's a mouthful. Let me walk you through it. We had a multi-week sell-off last August, if you recall, August into September, and then a bit of a bounce consolidation phase. And then I guess it was the first few trading days, one of the first few trading days of October, the bears tried their darndest to push the banking stocks lower one more time. You see that long skinny tail? They tried to marginally push it below the August lows, managed to do so on an intraday basis. But at some point, they exhausted themselves so badly that this market rallied back all the way higher, okay? And the very next day, it gapped up, and it was pretty much off to the races from there. Okay, the maximum point of bearishness was down here. They completely lost control of the ball, and there's only one way to go, and that was higher. Okay, let's give you a bearish example on the gold trust, the GLD ETF, which I'm sure many of you guys are watching. We had the topping process take place. This was also last October, November, so just a few months ago. A topping process followed by exhaustion buying, okay, strong bearish reversal, and follow-through selling. Let me walk you through it. Strong rally off the August lows from last year. We rallied right into the middle part of October. We arguably had a bearish reversal here. Now, I have something for you guys later where you can learn this one as well. But the real strong bearish reversal, visibly obvious to just about anyone that watched the chart, took place here, which was one of the last few trading days of October, I guess. And I remember we put on a short position at the end of that, actually the next day, and it was just beautiful, because basically what happened here is, again, let's think about this in price action terms. What happened in CNBC terms, I should say. CNBC terms say, well, Bob, we closed, off the highs. Well, what really happened is that after a prolonged uptrend here for a few months, the GLD topped out, and then on this day tried one more time, the bulls tried one more time to push this market higher. Failed to do so miserably, so there was absolutely no buying pressure left, and the market had only one way to go, and that was lower. Again, the maximum point, the best point to sell or short something is when the maximum point of bullishness is reached, okay? And a lot of times, or actually I said most of the time, if not all the time, that's very, very visually obvious by the big candles that you get on those days, okay? I'm going to skip this Hewlett-Packard example in the interest of time, but we will go through some other examples here in just a minute. Now, what's really, really important about all this process, and here's the three-prong trading approach, guys, write this down, okay? Step one, you have got to have an understanding of what the broader market structure looks like, okay? And by that, for the most part, I mean, have an understanding of what's the current situation in monetary policy, number one, and number two, where are we in the economic cycle? Are we in an expansion phase, contraction phase? Where are we, right? So like right now, for example, from a monetary policy perspective, you could arguably say we're in a confusing spot, but we're probably more in a tightening position than we are in a loosening position, multi-year speaking, right? I agree, I know some people probably think, well, the Fed might ease again. Entirely possible, but for the most part, we're certainly closer to a bit of a hiking position than we are a lower position. Now, from an economic point of view, after 7 years of a cyclical expansion or so, we are very late in that cyclical trend. In fact, we are having a contraction. If you look at the rate of change of economic data and corporate growth, top and bottom lines as well. So that's where we are right now. Now, once you have that understanding, and by the way, you don't have to read the Wall Street Journal, front to back every single day. In fact, if you do, you're probably doing yourself more harm than good. But basically, step number 2 then is to make sure that you're trading stocks, if you're looking at the stock market, broadly in the direction of what this step number 1, this big picture is giving you. I know a lot of folks out there are trying to teach you stuff, telling you all you have to do is look at price action and the charts. I'm telling you, I've done this for nearly 20 years, and I've worked at hedge funds and big investment banks. The reality is that it's not really how it works. You have got to have an understanding of where we are in the big picture, okay? And then step number 3, you look for these strong bullish and bearish reversals, such as the ones we went over. I'm going to give you a ton more examples here in just a minute. Now, I said before that you can reverse engineer all this, okay? And what I meant is that you can actually start with step number 3, which is to say that if you come across a chart and you see a very strong bullish or bearish reversal where there's maximum bullishness or bearishness reached, okay? You see that, then go back and make sure that that trade is, for the most part, should be in the direction of this trend, okay? Or if it isn't in the direction, make sure there's a really high probability that it's counter trend. We'll talk about this in just a second. And then again, make sure that that broader trend is still in conjunction with the broader market. Okay, so I hope you wrote this down or take a picture on your phone. This is a really important step, and I think a lot of people sort of, take this too lightly. Okay, all right. Now, let's go through the charts I just showed you and give you guys the perspective with the 1, 2, 3 step approach. Okay, this is the SP 500 multi-year chart. Okay, what you see here is essentially the bullish reversal that we just looked at before. In October 2014, that's this bit right here. If you understood at that point, October 2014, I got a lot of calls from hedge funds around the world in October 2014. I remember it very clearly. People called me and said, listen, they thought the market's going to fall apart. I said, listen, let's see and wait what happens once the market actually reaches the broad uptrend from 2011. Because in the reality, the economy was still somewhat expanding at that point. We still had a supportive Fed, or at least verbally supportive Fed, so everything was kind of going direction, and sure enough, the market staged a massive bullish reversal right at the multi-year uptrend line, okay? If you would have seen that and you would have followed the 1, 2, 3 step process, you would have bought this with both hands, and sure enough, we did so, and we told all the hedge funds to do so as well, and all the retail investors, anyone else that is following us. Now, the other thing is the BKX, the KBW Bank Index. This is just last fall, right? So what happened here is that the BKX fell very strongly into multi-year horizontal support. Now, from a step number 1 perspective, what actually took place at that point is that the Fed was trying to talk up interest rates, and then, of course, ended up actually putting in a bit of a rate hike in December, which ended up being more bad than good, at least for stocks. So what happened there was that basically the banks were started to rally, and this strong bullish reversal took place right at multi-year support. So if you would have seen that, understood the bigger picture, you would have had no problem buying that strong bullish reversal. Okay, let's look at the GLD. Okay, gold, which is a little bit more difficult to look at in terms of step number 1, the broad structure mark. So I'm going to go through what it meant from the broader trend and then the bullish or bearish reversal. If you remember, it was a strong bearish reversal that I showed you guys in the previous chart that took place last, I guess it was late October or early November. And that bearish reversal took place right at multi-year resistance. And remember, same thing here. I got a lot of guys calling me at that point and saying, listen, they think gold's going to break higher. So listen, let's wait. If we have a nasty bearish reversal, let's make sure we respect the weekly chart, the multi-year trend, and indeed, if we do get a bearish reversal, we should short this and not buy it. We did, and it was all good. Okay. Hewlett Packard, this example, we skipped that before. I'm going to skip this here as well in the interest of time. So I'm going to go through a lot more examples here right now. I want to have you guys give me some examples right now. I would like to walk through some charts you want to look at, and we'll look at the bullish and bearish reversals through the lens of investor psychology using Candlesticks. I want to walk through these charts with you, okay? Now, the important takeaway, candles show us investor footprints and emotions if you use them the right way, okay? We have to have a straightforward and repeatable process because that is the key to consistent profits as a trader an active investor. Again, the key is having a repeatable process. The three-pronged trading approach, I hope you guys have written this down. You've taken a picture of that slide before. Understand the broad market structure, understand the environment, and then scan for technically sound stocks, commodities, whatever, in the direction of that, that's in accordance with the broader market structure, and then use that 1, 2, 3 step bullish, bearish, reversal. We'll go through a lot more of those examples right now. Okay, and then you just watch your profits pile up, okay? So let's look at some examples. I want to give you guys a couple examples before we go through some of your charts. Oops, I just made that thing disappear. And I want to show you guys these charts just real quick so you have a little bit of perspective. So I'm going to show you guys an example I did for the money I managed and for subscribers as well in Nike. And this this trade in Nike took place right here on December 23rd to be exact. Okay, on December 23rd, what happened was that Nike tried to rally very strongly, and did intraday. It tried to push past the highs from October of last year and the highs from last November. Well, it did so on an intraday basis. It tried to give it one more rally day. That rally faded miserably, okay? And you can see what happened. The bulls completely lost control of the ball. The bears took over. Very next time we had a confirmation selling day, and it was lower from there, okay? Now again, through a lens of price action, you would say, okay, well, we are, closed off the highs, Bob, right? Useless. Think about it through the lens of investor psychology. What really happened is that the bulls tried to push this market higher one more time past very obvious resistance. They failed like, you don't see failures like that very many times, but when you do, you have got to take action, okay? And it was off to the races lower, okay? Another example I wanted to give you guys as well was in Facebook. Also a trade we did recently. In fact, this one was in February. What happened is that the stock rallied very, very strongly. I guess this is like right through earnings or into, I don't exactly remember, but what happened is we had a strong multi-day rally, and Facebook on this day right here, which was the 2nd of February, tried to push higher one more time, okay? And actually what happened is that the bulls completely lost control of the ball. They closed the day, not lower, but unchanged for the day after trying higher. Next day, strong or bullish reversal day, and it was lower from there, okay? If you can consistently pinpoint these points up here, guys, and start, buying or shorting stocks, depending on if it's a long setup or a short setup, you are going to become a much more consistently profitable trader. The bullish reversal, by the way, in Facebook, we also took that trade, was down here. The stock came in, tried to push lower on the 20th of January, failed to do so. Long bullet tail, bullish reversal, had a strong rally day the next day, and it was off to the races, okay? Okay, so those are the examples that I want to go through. Let's go through a couple of what you guys have. Not surprisingly, some people are asking about Facebook and some of the ones I just went through. Netflix is on there. Let's go through Netflix real quick. Okay, so Netflix had a beauty of a bearish reversal right here, okay? Now, sometimes you have to give these things a little bit of time. I'm going to give you guys just the most recent one here, the most strongest one at the top, and then we'll show you the one down here as well, which we also took. Okay. Now, again, think about this through the lens of investor psychology. It's going to make your life so much easier if you look at price action through the lens of investor psychology, because it allows you to actually stick with your system. Okay. So what happened is that Netflix rallied very strongly off those lows. I guess from the August lows of last year, then continued to rally, increased its slope of the line. Ultimately, we came into this period here, which started on the 2nd of December. You saw we had a multiple trading days where we closed off the highs, not dramatically, but off the highs. Then we had one more rally attempt on this day, never pushed above those highs. But the next day, this was the 7th of December, the market, Netflix tried to push higher one more time, completely failed the rally, pushed lower, fully engulfed the previous few days of trading action. And again, think about it through the lens of investor psychology. What happened is that the bulls failed. They lost control of the ball. There's only one more where to go, and that was lower. Confirmation selling day happened 2 days later. Okay. Let's look at, let's see, some people want to know, just so many stocks. Very involved audience here, guys. Really, really awesome. And this on a Saturday. Very good. Let's look through IBB. Let's look through IBB. Let's just analyze it right here, right now, okay? Let's look at IBB. Someone's asking about moving averages. I'm using very simple moving averages here. So these are just 50-day in yellow, 100-day in blue, and 200-day in red, okay? What's more important about moving averages is that we use them for perspective than as opposed to, like, you know, putting hard stops or targets right around them. So let's look at IBB, okay? So you can look at IBB, and we can just do a current analysis, okay? I don't, for the record, don't think that the biotech stocks have bottomed yet, much like the broader market, but I'll show you some bullish reversals that have taken place here. Now, what you want to look at is stuff like this. Now, this is a little bit more advanced, so I'll show you the ones we've already just went through, okay? So look what happened here. We had the biotech sector, the IBB, in complete free fall, of course, January through the early part of February. Then we broke below the lows here. Then we actually had a bullish reversal here, but I'll show you the easier one to spot, which occurred right here on the 17th of March. So just a couple of weeks ago. And what happened was that the IBB tried to push back below this horizontal line one more time, okay, and retest those lows. Well, on a daily closing basis, they more or less rallied right back to that resistance or former support line, and when 2 days later we had or actually even the next day we had a follow-through buying day, but the real meaningful follow-through buying day took place 2 days later, okay, and it hasn't been off to the races there, but you know, we've pushed higher since. So I don't know exactly where we go here, but we have very defined support down here. Remember one thing I talked about before, guys, was that stocks basically have a very the great thing about candlesticks, let me put it this way, the great thing about candlesticks is that not only do they allow us to tell us where to get in and where to get out, but they tell us exactly where we're going to be totally wrong. So if for some reason biotech stocks drop below this low again, because that's where we had a strong bullish reversal, you know exactly you got to get out of Dodge at the very latest, right? Of course you want to get out much earlier, but I'm saying that's at the very latest where you would want to go and get out, okay? Now, let's look at some more examples. Before we do that, though, real quick, I want to mention to you guys this quote by Albert Einstein: the definition of insanity is repeating the same behaviors and expecting a different outcome. So what we need is a plan. And a plan starts with knowledge, and if knowledge is what you seek, I would like to offer to you guys today my ultimate candlestick bootcamp. It's where I teach you guys the institutional three-pronged trading approach that I just went through in much greater detail. It's a low-stress, high-probability swing trading method, and you're going to learn how to nail bullish and bearish reversals correctly by reading investor sentiment and emotions using candlesticks and more. Now, the course is an 11-part recorded video series. Each video is 15 to 30 minutes long, and it includes a 30-page ebook, which includes beautiful charts just like the ones we just went through. It's at www.thesteadytrader.com/now, and I'm typing this into the chat box here as well. /now. If you guys go to that, it's a one-time charge. It's not a membership. This is just a one-time fee, $97. www.thesteadytrader.com/now. You can learn all about my three-pronged trading approach and how to nail bullish and bearish reversals. Okay. So. And also, by the way, there's a 30-day money-back guarantee. If for some reason you don't like it after 30 days, within 30 days, I don't really want your $97. Okay. Now, the question is, who is this course not for? I really don't think this course is for people that cannot be patient and disciplined in their trading approach. I don't think this is for people looking to for someone to just tell them every single trade to do, and it's really not for people that are unable to make their own trading decisions. So that's who this is not for. Conversely, and who the course is for people that want to basically become disciplined self-starters, disciplined traders, and really gain financial independence through really understanding the markets and not just kind of guessing and taking someone's picks for granted. Robert, yes, this course used to have a different name. It used to be called Pro Trading Course. I've renamed it Ultimate Candlestick Bootcamp. So if for some reason you already have this course, then don't buy it. Okay, you already have it. That's a good question. So let me quickly go through a little bit more about what the course includes, and then we'll go back to some examples. Okay. So testimonial by Brian Rachwalski. He was already a professional trader. He took the course, and if he can make it work, if this can improve his trading, then imagine what we can do for anyone that is not a professional trader. He said that a steady trader provides in-depth technical analysis unseen in other sites, and a thorough explanations on the intricacies of technical investing have made me a better investor. It's been wonderful to see how he's gotten so much better. It's been an absolute pleasure to see him grow after having taken the course. So what you guys are going to learn is my institutional three-prong trading approach to trading that I've learned over the past nearly 20 years at both the buy and sell side, and how I manage now. You can learn all variations of the bullish and bearish reversals. I only showed you guys a couple. There is more to this, right? A lot more to this. You can learn how to use candlesticks to trade in a direction of a trend and against it. You're not going to have to learn hundreds of candlesticks patterns because, trust me, it really is not worth it. Okay, people out there trying to teach you these funky candlestick reversal names, pattern names, is totally silly. Look at it through the lens of investor psychology, and that's what this course will help you. You're going to learn about my rocket launch setup, the gravity pull setup, and as a probability enhancer, you're going to learn about multi-time frame analysis, guys, and confluence zones. Okay. Yes, so this course includes all sorts of technical analysis and how to trade what I just went through the past 35 minutes or so. Okay. So again, www.thesteadytrader.com/now is just $97, a one-time fee. You can learn all this stuff, confluence zones, multi-time frame analysis, guys. So powerful. To learn and to use. You can learn also some other basic stuff that people would think is basic, but I'm going to teach you guys how it's actually being used, not how some people teach this academically. Sideways channel breakouts, wedge and flag pattern breakouts, trending gaps, how to draw correct support and resistance lines. A lot of people do that wrong. Moving averages, momentum oscillators, and Fibonacci retracements. It's all included in the course. Okay. You can also learn where to set your stops, a risk management strategy, the mental aspect of trading, and money management strategy as well. Okay, so again, it's www.thesteadytrader.com/now. So go ahead, pick up your copy of the course, and I would love to be able to welcome you on the course. You can always ask me questions, of course, as well. That's all included there. Now let's go through some more examples, guys. Paul's asking, do you need to purchase a follow-on program? No. No, this is it. This is it. That's all you need to buy. Okay. So let's see. Someone wants to know about TWOU. All right. So yes, it's $97 US dollars. Yes, absolutely. So let's look at some bullish and bearish reversal. What can we make out? And again, go back to what I said before. You always want to look for extremes. Okay. So TWOU. Is the ticker symbol in this one. Let's look at this one. You guys can see a very strong suspicious bearish reversal took place up here. Let's just look at this one, okay? I'm just giving you, we can't go through everything here, but like, for example, this was one hell of a setup right here. You can learn this in the course. An amazing bearish reversal. I don't know this stock, but it's actually a really good one, so I'm actually going to take note of it. So thank you for showing this. Yeah, so look at what happened here. So the market rallied higher. The market rallied higher here, and you can see it was trying to, in last September, it was trying to take out those highs from last August, okay? Well, it failed to do so. The market pushed higher one more time. It tried to rally on the 22nd of September, failed to do so, massively reversed off the highs, and the very next day had very significant confirmation selling. You can learn about this in the course, guys. The confirmation selling and buying is the key, okay? And a lot of people don't use that, is the key for a successful active investing and trading career. Now, again, a lot of people also way over trade. A lot of people just, kind of nervously tick around in these places here where it's just totally useless to do much. You have got to find the extremes, where the extreme of emotions are going to give you the highest probability point to buy a stock, or sell a stock. Let me ask you this. do you think you had a higher probability of selling the stock here, somewhere here in this crap here, or up here where the emotions were really high? I think it's pretty clear. Okay. Paul is asking, yeah, you can use any charting program for this. Absolutely. This is not dependent on anything specific. And I'm guessing I'm out of time, Reed, and unless you can correct me, but I'm assuming I'm out of time. So folks, just $97, www.steadytrader.com/now, and I'd love to see you. Oh, I got 3 more minutes, he says. Wonderful. Let's take some more. Walmart. Now, some people were asking about Walmart before. Let's look at Walmart. Okay, so Walmart, I'm actually, in full disclosure, I'm long Walmart, okay, right now. And that's because it's been just a beautiful, it's been a beautiful relative outperformer after a horrendous year last year. And look at Walmart did last year, it was just a complete disaster. But Walmart basically has had a very strong bullish reversal at its 50-day moving average a couple times now. So look at that, extremes of emotions, right? Now this is not absolute lows, but it works on trend, using a trend lines and moving average as well. And that's what you're going to learn in this course, is how to combine all this stuff. Look at that strong bullish reversal. Stock on the 18th of February tried to push below support, failed to do so, rallied back, confirmation buying day the next day, and boom, higher. Last one, RE. Actually, let me show you. Someone asked this before, Priceline, and we had some wonderful trades in this one. Let me show you the very strong bullish reversal we had when we did the trade the other day. This is a bit of a variation. Again, you're going to learn this in the course. Again, just $97, www.steadytrader.com. Look what happened here. We came into those mid-February lows. The market reversed, tried to push lower. Actually, well, it did push lower on this day, which was the 8th of February. The next day, we had a consolidation day, but on the third day, we had a strong rally day. And look what happened. We had a down gap on this day. Then we had a consolidation and an up gap in the next. It's a very, very strong bullish reversal. The bears exhausted themselves, and it's been the rest is history. So I think that's it for me. I got to jump. I got to go. Thank you so much, Reed. And to everyone for organizing. Thank you, everyone, for joining. Have a great rest of your day, your weekend, and hope to be able to join. Have you guys join me in the course pretty soon.